The next kind of expense we're going to talk about is depreciation. And this relates, at least in the example of what we'll be talking about here, to plant assets. When we buy something, maybe it's a delivery truck or a piece of large factory equipment or a building, we're going to pay for that, maybe out of cash, maybe we borrow the money, but we're going to pay for it. We can't take an expense for that entire thing at the time that we purchase it. If we did that, that wouldn't really give any justice to the fact that we're going to be using the building or the equipment or the truck for probably quite a number of years to come, and we're going to be using that item to generate revenue for us. And so we want to actually spread out the cost of that, the expense of this item, over the amount of time that we're going to use it. It's called its useful life. And when we do that, that's called depreciation. Now, often people think of depreciation in terms of something kind of deteriorating in terms of its physical condition. And that's not what we're talking about here. What we're talking about is a way that we allocate the cost of an item over the expected useful life. Now, there are a number of different methods to account for depreciation. The clearest and most straightforward is what's called straight line depreciation. And we start with the cost of the asset, what we paid for it. Now, often when we've decided we're not going to use something anymore, we don't need it, or it's not going to fit our purposes, something still is going to have a value. If we have a delivery truck, we may decide to sell it well before it's ready for the scrap heap. So it might have some value if we were to turn around and trade it in or sell it to somebody else. So that value that we expect for it to have at the end is what's called salvage value. And we're going to calculate the salvage value into that when we look at depreciation. So we use this equation, which is the cost of the asset minus the salvage value divided by the asset's useful life. And that's how we're going to allocate the cost of this item over the period that we have it. And in this example, Fast Forward purchased equipment on December 1st for $2,600. We think we're going to use this for 5 years. We think it's going to be worth about 8 years at the end. And so we purchased it on December 1, but now here we are at the end of December. So because we think it's going to still be worth $8,000 at the end, we're going to subtract that from the cost. And then we're going to spread the remainder of $18,000 over the next 5 years, or 60 months because we're preparing monthly financial statements here. So just again, a way to show how that net cost, how we arrived at the amount that we're going to be depreciating. And because we're going to depreciate that $18,000 over 60 months, that's going to amount to $300 a month in depreciation. When we purchase the item, and I strongly dislike the way that they do these, because all this shows is the purchase of the equipment. Obviously, we had a corresponding credit entry someplace else. Otherwise, we would have been out of balance, and I don't like the way that they only show one of these. So imagine somewhere in your mind there was a credit to cash or a credit to notes payable or something for the $2,600. But here we are now at the end of the month, and we need to record that depreciation expense. Now, we are not going to record that directly to the equipment account. We are going to record that to what's called a contra account. So this accumulated depreciation for the equipment, that's going to pair with our equipment account and really offset what's called the balance in the equipment account to get to what's called our book value of this particular asset. Meanwhile, over on the expense side of the equation, we're going to record $300 of depreciation expense. And that's the way that we account for the portion of the item that we have used up, the portion of the cost that we've paid that we've used up. But again, we've also got this asset of equipment over here. We can't leave that at its full value, so we offset that by accumulated depreciation of $300. And in journal entry form, again, always debits first, expense depreciation, debit accumulated depreciation equipment, debit, or credit, oh, sorry. But again, remembering that the accumulated depreciation is what's known as a contra account, and it stays paired with the, for lack of a better term, sort of the parent equipment account, and those two will remain associated. So what's this going to look like on our financial statements? On February 28th of 2022, after 3 months of depreciation having been taken, so at $300 a month, 3 months, we've taken $900 of depreciation. Our balance sheet is going to show, we're still going to show the original equipment cost, but right under that, we are going to show less, in other words, subtracting accumulated depreciation to get what's called our book value. So if anyone says, what's the book value of your equipment, you're going to look at the cost but subtract out the depreciation, and in this case the $25,100 is what our book value will be. Now that is just one of a number of different ways that depreciation can be calculated, but I'm going to leave those other methods for a different day and move on to adjusting entries for deferral of revenues in the next video.